Thank you, thank you. Thank you, Chris. So I love what he just talked about with Dan and Ukraine. Last night when we were at Topgolf, somebody asked me, how do you come up with your why and find motivation? And it was interesting because I've been reflecting a lot on that lately. And last night I had to leave early because I had to go to a training for my staff at my day spas and med spas that we have. Every January we get everybody together. There's about 125 employees, and I always do this goal setting. And it's kind of the same thing every year where we go through the highlights and people share some of their successes. Most of the people failed because they left the meeting the previous January really motivated, but did they actually go and execute on the plan and all that? Most people don't, right? So last night I was like, I'm going to shift this up a little bit. And I'm going to stop focusing on the target, right, or the outcome. And we're going to work a little bit differently. We're going to work more from like, who do I want to become? And what's the process in order to become that person? And then that's going to be the result. And it was really cool going through that process individually this year as I was going through all my goal settings, right? So for example, instead of I want to run a marathon, it's I want to be a runner. Well, if I'm going to be a runner, then what do I need to do in order to become a runner, right? And it might be run a marathon or whatever it is, but it's paying more attention to the journey and the trajectory that you're on versus focusing on the outcome. Because I think so often we get to the outcome, it's like, okay, well, I did that, now what? It's kind of anticlimactic, but we forget about what put us there. So I love the example talking about Dan going to Ukraine and now wanting to bring his wife in, and that's somebody that's just paying attention to the journey, right? He's focusing on the process and he's appreciating it as he goes through it. That was a tangent. Don't know why I even said that, but no big point to that. Besides, one of the things that I've realized as I've kind of gone through that is how much I enjoy the journey, the process of the work that I'm able to do, right? You've all heard me say this before, but houses, real estate, they're just simply a vehicle, right? They're a vehicle to help people generate more income, create more wealth, but it's for what, right? It's what does that represent? You know, what does that do for people? That's what's important to me. So here's what we're going to do today. We're going to talk about the economy and the market and what's going on. There's a lot, and it's changing fast. And the slides I prepare for this group, you know, I maybe share a third of the information on Thursday. So we're going to dive in a little bit deeper. I'm very open to having this be comments, questions, as I go through it. I can't really see you because these lights are like so bright in my eyes. So if you have something to say, please do. We will open up at the end for Q&A. But I really want to dive into what's going on, how does that impact real estate, the opportunities that we feel like there are as a result. And then like Chris said, do the STRs, the Equity Bridge Fund, just kind of give you some updates on all that, okay? But as a reminder, I want to go through this very quickly, okay? Real estate has 4 profit centers. We've got cash flow. We've got principal reduction. We've got depreciation. All of these are the operational side of real estate that represent your internal rate of return. And then we also have appreciation. And what we're doing right now is we're moving into a current environment where we can buy the same house for less than what it cost 4 months ago, 6 months ago. And we can actually buy with equity from the standpoint of we have motivated sellers. Okay, so I'm going to dive into that. But that bottom appreciation can look very different, right? If we owned houses going into COVID, we saw 20% annual appreciation, or we saw values grow very quickly. Well, markets changed a lot, and now we can enter, right, very strategically, okay? So I just want you to have that in mind. And then I also, there's my market update. Some of you have probably seen this before, but just to kind of put into perspective, before I dive into the market, the first 3 houses that I ever bought. because we're going to talk today about timing in the market and how the next 12 months, I believe, are going to be a phenomenal time to enter the market. But in the big picture, long term, timing isn't really that important with the strategy that we have. Okay? Here's a perfect example. First house I ever bought, second house I ever bought, third house I ever bought. 2004, 2005, 2006. Okay? When I bought them, they were worth just over $1 million. 2-3 years after I owned them all, they were worth $865,000. Okay? I was renting that one, renting that one, renting that one. They all had positive cash flow. Not very much, but a little bit. But did I have to sell them for $865,000? No, because I had positive cash flow. When everybody else was short selling their houses, losing them to foreclosure, I didn't have to because I had positive cash flow. Okay? Now what's happened over the last 15 years, and what are they worth? They're worth $2.1 million. Okay? But even more importantly, they've given me $700,000 in cash flow-ish right along the way. So if I were to sell those 3 properties today and add in the cash flow that I've gotten along the way, it represents $2.7 million. Right? So 4 or 5 years in, it was $865,000. I was upside down. I would have had to sell at a loss. Today, I'm up 2.7. Okay? Well, up 1.7, right, from the $1 million that I spent to buy them. But these houses are paid off. I've paid them off with the rent income that's come in. So now there's significant cash flow coming from those houses. So I want you to have that in perspective as we kind of talk the market and particularly how real estate responds to it. So monetary tightening can be painful. So quick summary, COVID happens, Fed prints $5 trillion, shoots it out everywhere, follows that with PPP, all kinds of ERC credits, all this stuff, and says, don't worry about paying it back, and they just flood the market with capital. Even though the market was basically shut off, it still exploded because there was so much capital that went into the market, okay? That caused inflation, right? Close to double-digit inflation. And now they're saying, okay, hold on a second. Now we got to bring it back. And what's very interesting is the Fed has a previous experience and knowledge of how to stimulate economies. They've done it in the past, right? The financial crisis, .com, 80s, 90s. There's been many instances where they've used their power to stimulate an economy. Very rarely have they ever had to step in and say, hold on, we got to pull this thing back. And so what they're doing right now really hasn't been done before, especially to the extent that they're doing it. So obviously they raise interest rates. That's the vehicle or the tool that they have in order to slow everything down. And it's working. It's working quickly. And I'll show you a lot of information that kind of shows that. But is there a chance that they pull it back too much and it puts us into a recession, right? It's 6 months ago, everyone was worried about inflation, and now that's been replaced with recession. And so that's kind of where in the world we are right now is how much are they going to pull it back? What's the true impact of it? And what's the result, right? And then where do we move from there? And I'll show you some information, but in my opinion, I think they're going to overdo it a little bit on the pullback, particularly because as they make decisions and lower rates, it takes time for the impact of that to trickle through. And then I think they're going to try to turn it back on. And how are they going to turn it on? What are they going to do to interest rates? They're going to lower them. And as they lower interest rates, it's going to turn everything back on. And I think they're going to want to do that in 2024 when they're heading into an election because they want the economy going in the right direction, right? Solely from a political standpoint. So let's dive into it. You look at the Fed's balance sheet. Look how much it's gone down, $3.1 trillion, okay, in the last 7 months. Huge, significant 6 months change. Manufacturing orders are at a 40-year low. How come manufacturing is down that low? They're not making as much stuff, right? But why? Huh? Nope. They're not buying it. Why aren't people buying? Because the prices went up, right? So they're not making it, okay? Consumer goods, washers, dryers, okay? This is interesting. The blue line, let me make sure I don't mess this up. Personal. Blue line is manufacturing, gold line is consumption on the consumer level. So manufacturing has fallen off. Look at consumption, okay? Why aren't people buying washers and dryers or fridges, ovens? Has new construction slowed, right? Are interest rates higher? The cost, everything, okay? Imports. So we had this crazy COVID where everything was coming in, and now it's back to here. And if you look at just the normal line, we're about to where we kind of should have been all along, okay? Inventories. So I'm going to talk inventory just a little bit, right? I've got these med spas, day spas, and we have an element of boutique. So we have a lot of women's clothing and handbags and jewelry and shoes and all kinds of stuff like that. And I have to turn my inventory 4 times every year because there's 4 main seasons, especially in Utah, where our climate is very seasonal and temperatures change. And so if I don't turn it, I've got to put it on clearance, right? So I get my money back so I can pay for the next one. And I'm always playing this retail inventory game. And I have to order about 8 months in advance. So for example, all my spring starts to come in February and March. I have to order that, it shows, basically in like April and May. So last April and May, when I ordered for spring, I thought I was going to have a hard time getting things because we were ordering all types of stuff, and then we were getting calls saying, sorry, we couldn't produce it. Sorry, we couldn't produce it. Sorry, we can't ship it. So we over-order, thinking it's going to get cut down, and we're going to get something. And the economy was doing what last spring? Exploding. So now I've got this massive shipment or shipments coming in over the next 2 to 3 months that I ordered under different market conditions, and they were actually able to produce a lot higher percentage of what I ordered. So I'm going to have too much inventory, okay? If I have too much inventory, what do I have to do to sell it? Prices got to go down, okay? And I'm just a little blip, right, of how this all works. You'll see stuff from vehicles, all kinds of different things. But now we have too much inventory, and so that's just going to bring prices down. Look at shipping rates. Okay, I've got a buddy that's, I don't even know what you call it, like a port guy in Long Beach, logistics, whatever, deals with all the ships and containers that are coming in. And 8 months ago, I call him. What's he telling me? He's like, I'm looking at binoculars, and there's hundreds of ships out there waiting to dock. And right now, it's like there's nothing out there. If a ship pulls up, they can just dock. Okay, so very, very different climate of the amount of inventory that's coming over as well as the cost in order to get it here. Used cars. I knew I had this slide, so on my drive in today, I drive on State Street, this main road out here, and I pass, 30 car dealerships as I drive here. And I really wanted to pay attention today as I was driving in. And it's interesting because those car lots are full right now. Compared to 8 months ago, there wasn't a car on the lot, right? And so obviously rates going up, that means how do most people shop? Do they shop price or payment? Payment. Most people shop payment. So why did housing explode like it did? Because people are shopping payment. They were less concerned about the price or the deal, more concerned about the payment. Well, when rates are 2.5%, they can afford a lot more, right? Same thing with vehicles. So now they're just coming back to earth and then some, to tell you the truth, because there's so much inventory out there right now. Gas. Who remembers in the summer, the whole conversation was gas, right? And how expensive is it? And how expensive is it going to get? When you look 12 months over 12 months, it's down almost 3%. So where it is today or going into January, it was down versus going into January 2022, okay? But it was a roller coaster. It went up almost 100%. Lumber. Did anyone build a house like right here during this time? Anyone? My condolences. Hindsight, right? But you look at it, it's down to, I guess it was that cheap right when COVID happened, but prior to that, before COVID. But really back down to where it should be for the most part. Natural gas, okay? Ukraine, Russia. Remember all the talk of how is Europe going to heat itself this winter? Somehow they've been figuring out how to source it, how to get it, and look at the prices, how much they've come down over the last 30, 60 days. Okay, so they're not having to overpay for it either. Houses. Okay, so this one's really interesting. There's a Great Recession, right? The crash. There's COVID, which was straight down and straight up because of the stimulus and the interest rate. And look how low we are right now. So this is new contract signings. So this is buyers, right? So this is showing you the activity in the housing market right now. Well, why aren't people buying houses? If somebody bought a house anytime during here, they overpaid for it, right? The price was high, but their interest rate's 2.75, and their payment's low. And do they ever want to sell that house? No. They do. The only people that are selling houses are people that have to sell houses right now. The whole upgrade market is gone. It's literally on pause because nobody's upgrading by choice. Very few people are upgrading by choice because they don't want to give up the 2.5% or 3% interest rate to get a 6% interest rate, right? Even though the deals are better on the purchase price. So it'll be really interesting to see kind of how this works out. I'll show you a few more. Has there ever been more houses under construction? Why are there so many houses under construction? Because we have a massive shortage. But does it take a minute to build a house and to get permits and buy land and do all that? So prior to the interest rate hike and demand going way down, builders were going as fast as they possibly could. So now you have excess inventory. This is single family homes. This is multifamily. Never been this high in construction right now. Does that mean there's probably going to be some deals? Yeah. Do you have motivated builders, motivated sellers out there? Especially in certain markets. Okay? So we have demand at almost all-time low, and you have supply heading into almost all-time high. This is under construction, so this isn't on the market. If you actually track houses on the market, it's about pre-COVID levels. And it's really, it's a two-way market right now in real estate, which I like, especially as a buyer, because now we can negotiate, we can source more strategically, we can put out a lot of different offers, and if we don't get them, it's fine because there's something else to buy. We know eventually we're going to get the deal we want. So I love buying in this type of environment, but it's changing, okay? This one's very interesting because this is the manufacturing prices, and this is the CPI index, which always lags. Meaning this is what consumers are paying, this is what manufacturers' costs to produce are, okay? It's starting to turn over, but we have a lot more price correction, right, to go, especially in certain categories like food, for example. But it's coming. So our price is going to continue to go down. I think you can safely say yes because the costs are going down, okay? Here's the food one. So here's your cost of food. Look at that. And here's what consumers are paying. When we go to the grocery stores, does it still suck how much we're paying? Yeah. Like food is lagging behind many of these other price corrections, but it's coming. I have another chart. Is it this one? No, there's another one somewhere that I'll talk to you about that. So what do all the smart people think is going to happen? This is the bond market, okay? So this is what they're pricing in, all the big funds right now. So they're saying the Feds are going to keep increasing rates a little bit. I think everybody here would agree that they probably got to go up a little bit more before they level off. But look what they have happening over the next 2 years, the end of 24. They have them bringing it down about 2%. And that's this whole, we get to here and it's like we probably overdid it. Okay, did we force a recession? I don't know. But did we slow it down maybe a little bit too much? We probably did. So now we got to turn things back on. And they're not going to turn them on like they did with COVID, which was this, right? Because they had to. It'll just be this gradual turn back on, which, in my opinion, would be semi-healthy for the overall economy because at some point, housing prices, they're going to almost be opposite this, right? I think they're going to keep trickling down. And then once interest rates start going down, they're going to start trickling back up. And so this is the opportunity, which I really feel like is the next 12 months, where we'll probably see the softest pricing that we're going to see for a while, because it's going to take them a while, because they're going to slowly decrease those rates to stimulate. How's consumer sentiment? Are people excited, confident in the economy right now? No, all-time lows. Look at 2022. There were 0 weeks where people were more bullish than bearish. 0. It's never happened before. COVID, financial crisis, right? 93, late 80s. We've never had a 0 until this year. Small businesses. So they still have cash. There's COVID, there's stimulus, there's PPP, there's ERC, and they're maintaining those levels. So much higher cash is in small businesses than pre-COVID levels. Individual investors, okay, have more cash than almost ever before. Households, this is interesting. So right now we've drawn out 21% of our credit card debt and 38% of home equity. So is there a ton of home equity? As much as I wish that real estate would just go on clearance, I don't see that happening, because are there going to be foreclosures if people have so much equity in their homes? If somebody can't afford their payment, what are they going to do? Sell it. Because they have plenty of room. Can they discount the price and still sell it and still walk away with equity? Yeah. So that's where I think we're going to see prices continue to come down for the next little bit. But I don't see a ton of foreclosures. However, I think it was Capital Bank or somebody, literally just this morning, I heard something that they're allocating or setting aside $1 billion for foreclosures coming up. So they're going to start happening, especially people that bought in that peak price as interest rates started going up climate, where they paid a lot and their rate started to be higher and they don't have any equity, right? If you bought 6 months ago and you lose your job today, are layoffs happening? Yeah, every day it's 10,000 here, 20,000 here, right? Especially in tech. So people's income is going to get impacted, and there are going to be some people that can't make their payments, okay? Credit cards. This is Bank of America. They put out this data on their quarterly call. Those are the average credit scores for the different loans they're giving. I mean, phenomenal, right? They're basically just saying, we have so much money that we're only going to give money to people that are super responsible and very low risk. So really what it comes down to is it a crash or is it a correction? What do you guys think? Correction. I agree. I really do not see a crash. Could we see certain markets crash? Is Boise, Idaho getting absolutely demolished right now? Yeah. My brother just moved to Emmett, bought a bunch of farms out there, and he's getting ready to go buy all of Boise, I think, next. Because, yeah, there are certain markets that are getting hurt more than others, so it's important, obviously, where you are. But generally speaking, broadly, Mortgage delinquencies are still very, very low, okay? Better than pre-COVID. There's tons of equity, and people are not accessing the equity like ATM machines, like they did in 2005, 6, 7. Okay, it was almost like if you had equity in your house, just go get it, because you could do heartbeat loans, and you could get up to 100% of the value, because everyone thought values are just going to go up forever or something, right? And they were just accessing that equity like crazy, and they're just not doing it right now. They're very responsible, okay, with what they're doing. One other thing I'll say to this, you see all those monies in those small businesses. Again, I'll use my it's really my wife's. I take credit for it up here, but it's her company. She does all the work. But it's called Amara. I'll use that as the perfect example, okay? We were impacted from COVID. In fact, we had to shut down. We laid off 131 of our 132 employees. The only person we kept was the HR girl to help process all the unemployment workers, all the just disaster of paperwork, okay? But fortunately, we're in Utah, and so we were able to open up relatively quickly and hired the majority of them back, and are very fortunate for how all that worked out. But I qualified for PPP money, which I took, first in line. And I also qualified for ERC money. PPP money I did not have to pay back, right? I got multiple 6 figures in PPP money. And then I also got ERC money, which I do not have to pay back, but I have to pay taxes on. So call it, I get to keep 60% or 65% of every dollar that they gave me back in my tax money, I'll call it. What have I done with that? It literally sitting in the bank. Because one, at first, as I was scared, like, what if I need this for operations? Or what if I need this to pay this inventory bill? I just ordered all this stuff, it's here, and I don't have anybody to sell it to, right? So there was real need that stuff helped, especially PPP when it came, because it came fast, and there's legit pain that helped, but I got more than I needed. So it's just sitting there. So it's been sitting in a savings account making 0.1001 or whatever, nothing of interest. Until probably 2-3 months ago, I started shifting them all over into money market accounts, because now what can you make in a money market account? 3-4%, okay? I'm also stacking CDs, 6-month CDs, and I spread them out over 6 to 12 months, and I put a certain amount in each one so that it becomes liquid as it goes, and I'm in the 5% there, okay? So now I'm just saving that money, but I'm actually making money on it. And my real estate portfolio, personally, most of my debt that I have is in the 3% on my investment properties. Am I going to accelerate paying those off? If I can make 5% in a money market or CD, would I ever pay off 3% money with that? No, it doesn't make sense, right? Especially because I get to deduct the interest on that cost. So my true cost isn't even 3%. So I'm making twice as much as that money's costing me. So one, I don't want to sell those houses because I don't want to give up that 3 or 3.5% interest rate. But two, I have this stack of cash that I've reserved for operations or whatever that I ultimately haven't ended up needing that's just sitting there. And there are many, many businesses out there in the exact same scenario. I talk to them all the time. And they just have all this money. I'm like, what do I do with it? And many of them, like I paid off lines of credit, or if I did like tenant improvements and I had a 7% loan or whatever it is, right? I wiped out all of that with this free money that came out there. And so then what does that do for operations? It creates more cash flow because I have less debt carry. So that's why we saw this record number of profit from businesses. And again, I'm just a small little company, but you look at these big, massive businesses, and then when they do it at the scale they do it at, the amount of additional profit they were able to generate is crazy, right? So that's just kind of an example of like real life, what's going on. But there's a lot of cash still sitting on the sidelines, which definitely means highly unlikely there's some crash coming, right? If there's so much cash out there. I won't read through all these. I've talked to most of them. I think the very bottom one's important to highlight, that I think the Fed has fully admitted that if the economy needs stimulation, they are willing to do it, okay? So they'll reach a point where they stop increasing rates, and if they feel like they need to turn it back on, they're going to. You saw that in that bond graph that I showed, going down 2% rates over the next couple of years. In fact, I don't even think it's willing. I think they feel like it's an obligation that they have, right, to turn it back on. Talk to most of this. Some of the concerns, right? We've talked about over tightening, stubborn inflation. Tell me why is rent so stubborn? Like when you look at the CPI index, if you look at it, including housing and excluding housing, right? Very different. Like it'll show inflation below 3% right now if you take out housing versus where it's at. Why is that? How often do rents change? Once a year? Sometimes even longer than that, right? Especially on a commercial level. And so the Fed's increasing rates 6 months ago, 7 months ago. If somebody signed a lease agreement in April, has that impacted their rent at all? No. So what we're starting to see is these rents renew, and it's softening a little bit, right? Obviously it's different in different locations and different price points, but even in our box that we do, we're seeing rents, soften's probably not even the right word, they just stopped going up. So as a result, they've softened a little bit, okay? So somebody may renew for $25 less, maybe $50 less. Very nominal, but when you look at that on a big scale, especially in these markets that have softened a ton, you're gonna start to see housing have a much bigger impact on CPI. Russia's obviously a big caveat, because who knows what they're going to do. I put this in here because just the whole panic selling thing. So the M&A environment is really dried up, right? It was very, very active the last couple of years, tons of acquisitions and mergers. And now it's very soft, and it's really dried up. And so you have a lot of companies saying, hey, if I can't get this crazy multiple, then I'm just going to keep doing what I'm doing. But I don't think we're going to see a whole lot of just panic selling, of people that feel like they got to sell now or they can't keep producing profit or keep their operations going. So I've kind of talked to it along the way about the opportunity, but it really comes down to a couple things for me. One is being in the right market, okay? If we'd built our entire real estate portfolios in Boise or Las Vegas or anywhere out west, Utah for that matter, have those markets all softened a lot more than the markets where we have the majority of our houses? They have. And the actual appreciation in those markets wasn't that much more than where we are. But it was that correlation to rent and affordability and wages and all those other factors that we take into consideration when we identify the right markets that protect us much better when the market slows down, okay? So being in the right markets, and then is single family the best asset class to be in? Let me show you what the big boys think. This is very interesting. Over the last 2 to 3 months, you'll see a lot of these articles from November, but you have all these big institutions now saying, we want more single families. Typically, they go multifamily, right? These big REITs that buy real estate at scale, they go commercial or they do storage units or they have the little niche. But a lot of times they don't enter the single family space. And why do you think they don't? Some company has $1 billion they need to allocate to real estate. Why do they not go buy houses one at a time? Say louder. Yeah, it's a lot of work. Not very many people are willing to go out and vet 20, 30, 40 houses for every one that they buy, right? If you've got $1 billion or $100 million to place, it's going to take you too long. And how do you build that infrastructure, right? Which is why our model is so unique, because not very many people are willing to do all the work. They'll just go buy some big apartment complex for $40 million and they spend their money much easier that way, right? But look at some of these announcements. JLL, a big real estate trust. Where does it say my number? Oh, aims to amass a $500 million portfolio in single family over the next 2 years. JP Morgan aims to acquire $1 billion in single family rentals. And they're going to deploy $415 million to do that. Meaning they're going to go in at a 50, 60%, right, loan to value ratio. But it's a lot of houses, okay? How does somebody like that go out and buy that many houses? The inventory's there, right? And they're going to look for pockets of houses that they can just go buy. Do you think there's opportunity for us to liquidate? What about like the consortium funds, right? Hey, JP, I've got 190 houses, all relatively new in good neighborhoods. They're all leased, Are you interested in buying those? And guess what? I'm going to charge you a premium because I did all the heavy lifting. Are they willing to pay a premium for a portfolio like that? Mm-hmm. So it'll be really interesting to see what type of opportunity there is or isn't for us on that side of things. But there's something to say that they're willing to do more work than they normally do to go allocate $1 billion, and why they like the single families, okay? This just goes back to be in the right locations. You hear Florida in the news all the time of why everybody's moving there and all the advantages and and all of that. But if you look at it just of where people are going in the U.S., not state specific, I mean, look at the South, right? And that's basically where all of our markets are, okay? The blue is 2021, the green is 2022. So basically, everybody's leaving the Northeast. Is anyone here from the Northeast? You're still left? And they're heading either south or west. That's basically what's happening. But you have a lot of people in the West. It's interesting, like the California pocket of it, where California is losing a lot of people. Okay? Okay, so that's it for the market update. A lot of information. I love to geek out on this stuff. You guys know this. But the better I understand all of it, how it all correlates, I feel like the better we can vet the right markets and present the right opportunities inside of those markets. We, especially the last probably 3 months and for the foreseeable future, are spending a lot more time and resources vetting markets. Because I want to make sure that we know when there's opportunity, that we know where it is best and that we are ready to just pounce on it. And I think time will tell if there are some markets, we're not just going to go open up in Boise while it's in the middle of a crash, because it still doesn't make sense with what rents are, what values are, all of that. But at some point, does one of those markets that is softened drastically make sense or make more sense to be in than the other ones that we're in? So we're constantly looking at that. Okay, I'm going to give you a quick update on Bridge Equity Fund. There's all the disclosures that apparently I have to put in there. This one's very interesting because here's what happened. Or Equity Bridge Fund, I always say it backwards. We created this concept in Q1 of last year. We started raising capital in Q2, and we started deploying it end of Q2 into Q3. What happened Q2 to Q3? Did the market shift? Drastically, okay? So we even got to a point where it's like, hold on a sec. We raised it for this purpose. Like, are we going to be able to execute? Or what are we going to do? And how do we adapt to this? And do we feel like we can do it, and we can do it well? Or do we just say, let's unwind this whole thing and go back, right? So let me show you what we've done. Because going into it, it was lack of inventory, it was excess capital in the market, and we're missing out on too many deals. Okay, so the cash was going to enable us to get access to deals. That was the main purpose. Well, what's today's problem? You have excess inventory, so exact opposite. You have prices softening, and you have less buyers and competition. So how is that cash important to us? I'll tell you how it is, and we've learned this from the consortiums. Because every time we buy a house with those funds, it's cash. And when the market was booming with COVID, we got access to deals we wouldn't have got access to otherwise. And that was where this whole concept was birthed. Like, oh, wait, look what cash does. Well, now what are we doing with cash? We're just lowballing, plain and simple. Because there's a lot of inventory out there, there's motivated sellers. And so now we're cash, and now we're king, not you. Buyers own the market or control the market, and we're totally fine putting an offer out on 6 houses and getting one of them. And what we're finding out, especially with builders, is we'll cherry pick the deals that they have, the lot location, the phase, all those different things, and then they'll say, oh, we'll discount it to here for you because you guys are who you are and you bought this many houses. And we're like, okay, great. And then we offer a little bit less than that. And then they usually say, sorry, we can't do it. It's okay, no problem. And then they call us back 3 days later and say, okay, we'll do it. And then we say, okay, for $1,500 less, just cuz. And it's fun. Like, I love it, right? Yeah, clap on that one. And we're doing it because we can. And the reality is they still like us, right? And they still produce a good product for us. And we literally have builders where I'll get on a Zoom call with like big regional builders in the South. The main president dude, and then his main sales guy, and then 10 other people are sitting in this conference room saying, what can we do to earn more of your business? Like, I couldn't have gotten on one of those calls 12 months ago if my life depended on it, because they were all so busy and there was a lineup of buyers, right? And now I can customize finishes. We can request more of certain floor plans because they rent better and they pro forma better. I can say I want houses facing this direction, I want this, I want that, like all kinds of stuff. It's just like I just start just talking. And here's my wish list. And they just keep writing notes and say, okay, we'll come back to you. So it's a great time to be buying. And again, I think that environment is going to continue. And so can that cash now enable us to get a better deal than we could get otherwise? It does, right? So same concept, it's just getting us a better deal instead of getting us access, okay? Before, I kind of talked through this. This was the point of all of this, was we get access to more deals by having the cash, and then we refinance it, and the clients pay about what they would have otherwise, but they get access to it, and they weren't getting those deals otherwise if they were financing. Well, what is it now? Okay. I don't know if I'm supposed to put low ball, but I wrote low ball. Motivated sellers. Same end results, right? We can use the cash here. We can then refinance into conventional financing, and they're still into the house as good or better than they would have been otherwise. And that's the part we have to be very careful with. Because what we don't want to do is overpay a little bit for a house. And keep in mind, this is for financed buyers coming through the system. So if we can use the equity bridge capital to negotiate a better deal, and then we refinance it into a normal long-term mortgage, after the cost of the money and the refinance, are they better off as a result? Okay? And that's what we have to analyze. So if they're paying $3,000 less for that house, it doesn't work. Right? If they're paying $15,000 less for the house and it costs $7,000 to facilitate it all, they're better off. And so that's the main function of this right now, but this is what I'm excited about, okay? If the auction, foreclosure, short sale market, if that comes back, this money is phenomenal for that, because then we can go and we can buy at a wholesale level, we can rehab it, we can then position it for a long-term hold, and we can deliver a product to our clients for way better than they could if they went and just bought a house on the market. And Chris and I did this hundreds and hundreds of times from 2009 to 2014. This was our main model of acquisition, was through auction, foreclosures, and short sales. Okay, it's not here. I don't know if it will be or how big the opportunity will be, but that's something that we're looking for on this. And then we also have some development project opportunities. I see a lot of pitch decks come through my office. People get them, say, Tyler, take a look at this. Pick this apart. Whether it's they're going to buy some apartment complex and it's a 3 to 5 year turn, they're going to go in and they're going to upgrade each unit as the tenants turnover and the amenities and then eventually resell it, or they're going to go build a bunch of townhouses, whatever it is, right? And so I get to see all these deals coming through, and there are a lot of people that put together deals 2021, 2022. They raised capital, and then they started executing on those deals. They bought the land, and they're in. Well, the market's changed a lot. Or there's a lot of people that raised cash first part of 2022, committed, closed, and now they're starting to build in 2023 or end of 2022, completely different market. So I think there's going to be a lot of opportunity out there, people that just aren't able to see it all the way through because the market's changed. They didn't have a good enough plan B or whatever the case is. So there may be opportunities there, or you may have people just unloading land, right? How many builders just stocked up on land, and now there's not the demand to build, and so they're just going to get rid of it, or whatever the case is. So there's opportunity here, and I'm going to bring up Arthur and Ruben in just a second to talk about one that we're currently doing. And then also, bank money isn't so cheap. So if people are developing, they'll pay 8 to 12% on development loans right now, where it was so cheap. And so for us to come in as a lender with the appropriate collateral, there's opportunity for hard money lending because there's not such a big spread. Nobody wanted 12% equity bridge fund money if they could go borrow at 4%, right? But now if you have to work with a bank and it's 9% or work with us at 12%, we're easier to work with. I think there's opportunities there. So I'm actually really excited about what we can do with this. I'll show you the results so far. It took us a little bit longer to deploy it. Again, we raised it Q2 primarily and started deploying in Q3, and then the market started to shift, okay? But we still have profits. Last year, we earned about 9% ROI. There's an asterisk by there because on this Portland deal, we structured it, it's a development deal, but we structured it where we have an interest rate. So we make a 10% return every single month on that money, but then we also have equity. And so we're giving up some of the ROI today for a bigger hit down the road. Okay, so that's kind of diluted that. If you kind of exclude that, it's closer to like 15%. And our target's 15% plus. But I'm pretty happy with what we ended up doing, to tell you the truth. I know we did a Q3 distribution. We're doing a Q4 distribution. There shouldn't be any quarters where we're not doing distributions because we have money allocated. It's producing fee income, interest income. So that's what that looks like. Talked about that. Okay. We did a loan to a solar company. Some of you may know Josh, but that's been great for us, right? We give them capital. We don't have to turn it. So one of the challenges with a fund, especially when you're doing short-term deals, is you do a deal, they pay it off, and then it's in your bank account. And then you have to go source another deal, and then you do that deal, and they pay it off, and then it sits in your bank account, and it's the time that it's sitting in your account that it's doing nothing for you, right? And how do you minimize that? And so some of the, like this one, for example, this loan we have, it's out there, and we get interest on it every single month, right? In this instance, it's 18%. So it's in alignment with our target ROIs. Portland, I'm going to give you a quick summary, and then I'm going to have Arthur and Ruben come up. But we funded this one on October 20th. What we're doing is we're building 25 townhomes. And the timing of this was awesome because I personally built 48 townhomes in Mesa, Arizona, and 32 townhomes in Gilbert, Arizona during 2021 and 2022 with some partners. And so I was very comfortable and familiar with a project like they're doing. The timeline is 6 months permitting, which that clock's going right now, 12 months construction, and then about 6 months of closing, so about 24 months. The cost of the project is $6.27 million, okay? Projected sales are about $9 million. This takes into account market softening, all these things. And we're coming to market with entry-level type of house. I always like to have a plan B, as do Ruben and Arthur, and worst case scenario, we could rent them and cash flow positive. And any development project I ever look at, that's always what I look at. Because if we can't sell them for a profit and we have to hold them, can I live with that? Okay. But we invested $1.5 million into this, and the ROI projections are 26.5%. So that's the portion that should come to Equity Bridge Fund. When you look at the total project, that 111%, basically what happens with that is you annualize it, so you cut it in half, and then we have partners on the deal, and so then you cut it in half. That's how we get to this annual number for the most part. But again, we're able to structure it in a way where we collect interest along the way. So it's a loan so that we're not just diluting all the other returns and you're waiting 24 months to see that really hit. We're getting some along the way, and then we have the pop at the end. So with that, I'm going to bring up Ruben and Arthur. Come here, guys. Do we have yeah, there's a mic. All right, give it up for these guys. So we met them through Investors Club, and super sharp individuals, and a lot of people, Chris will toss people over to me all the time. Hey, Tyler, these guys hit me up. Can you vet them out? All the time. And so they were part of that list, and it took me a minute to kind of warm up to them. And then I went up to the market. They toured me around. They showed me everything that they've been doing, and I was super, super impressed. And I'll say this, and I'll let you guys talk for a little bit, but first and foremost, by their character, right? I don't care how good a project looks. If I don't trust the person or believe in their work ethic or their core values, then I don't want to do business with them. Because when things go wrong, right, true character comes out. And so first and foremost, I love their character, right? Who they are, how they conduct themselves, who they currently do business with, all of that. And so they checked that box for me. And then it was, well, what's their acumen, right? Do they have the ability to perform on what we're doing? And, if any of you went up and spent a day with them in their home market and saw what they're currently doing and their knowledge of that market, I promise you'd sign up and say, okay, where do I sign? What do we do? So with that, guys, tell us a little bit more about the project, the market, all that.
So my name is Arthur Rapolov. I wanted to start, if you can go on the next slide. Wanted to give you a little bit of background of who I am. Bryce, who shared up here yesterday, his story of walking up to Chris and saying, hey, I want to be mentored by you. I did a similar concept in Vancouver, Washington. There was a mid-sized developer, and I heard about him, and I said, I want to get in front of that guy. I'm in the auto industry. My dad's been pushing me, get into real estate. So I said, you know what? I'm going to get in front of this guy, and I'm going to do whatever I have to do to work for him. So anyways, long story short, I got in front of him, and he said, I can't offer you a job. I had a bachelor's degree in project management, business management, and he said, but I can let you work for free. So I said, you know what? Working for free is all that I need. I did everything I could, and to fast forward, I went to managing projects from start to finish for Dutch Bros, Starbucks, Jiffy Lube, and other national tenants. Next slide. To doing full-time acquisitions and overseeing the project management division, to where I got to acquire 33 acres. That included frontage of 6 acres of commercial, national tenants including there, partnering with a general contractor and building out 180 apartments and selling it to Alliance, which is the #1 multifamily national group, and then also developing 215 townhomes to a national builder, which brings me to Ruben.
And so I worked for a national builder. My name's Ruben Rapolov, Arthur's brother. Everything we do, we have separate businesses, but we work together. So Arthur's the developer, and I'm just the general contractor. And
You do the heavy lifting.
yeah, and so
It's not just.
I worked for a national builder and built out subdivisions just like this one, and we came together and started to crank out the whole Portland market, and we've had a lot of fun past, I don't know, what has it been, 5 years now, and we're excited to be with you guys here.
Yeah. So really cool combination where you have the Arthur can go in and source, identify the deals, underwrite them, do the forecasting, pro formas, and that piece of it, and then you bring in Ruben who does the actual vertical, right? And so you have the horizontal or the deal structure part of it, and then now we got to go build it. And both of them had awesome training, learned from other people on their dollar, learned what they liked, what they didn't like, what they would change, all of that, and then broke out. And then let's look at some of the projects you guys have done together.
So this, I mean, I can go into this. This is the
Okay.
general Portland market. What we've really seen, we started in Vancouver, Washington. When I worked for that development company, we were doing a ton of Vancouver, and we were seeing there's tons of product, thousands of townhomes, thousands of homes selling in that 300 to 500 price range. And we looked over in the Portland side, we said there's nothing. Everything is selling for 700,000, 600,000, and there was a lack. And we got connected into this inner builder mastermind where the top producing real estate agent, Derek Bottle, was there. And I said, Daryl, what's something that's missing in our market? And he said, we have nothing for 400,000 in Portland that's new. So we looked at each other and said, you know what? We're going to take that and we're going to run with it. And so that's what brings us to today. And the general North Portland market, which is where Fessenden Townhomes is located, in the last 12 months, there's only been 30 units sold that are 2-bedroom. And the majority of that 2-bedroom unit is in the 400 price range. And currently, there's only 14 active listings out of the entire city of Portland market. So we're really focused on specializing in that, and Ruben can get into detail on what he's built.
The funny thing is every one of these listings, we know the builders personally, and we're friends with them. And it's crazy because they're just selling like this. People want a small unit, 2-bedroom, 2-bath, college roommates. They want their own bedroom. They want their own bathroom. And they're just selling. This is 18 units that I just built. I actually had a closing yesterday, closing today on 2 of them, and I have a couple more to go.
So I want to talk about this one because this is one that they've done outside of us, right? Very similar to what our project is, and they just came to market, 4 months ago, and sold them all. So extremely different market conditions is when they entered and started, but this entry-level price point kind of survives, right, those market shifts because people still need that entry-level housing price point.
Yeah, and a few of these closings was very interesting was Florida buyers, Cali buyers, New York buyers, and people moving to this area that want something like this. And I think for this 18 unit, it took from start to finish to sell about 3 months. And Ruben actually cranked this whole thing out in 9 months.
Yep.
So he phased it out in 3 phases, 2 buildings per, as well as, he won't say it, but I will. Like we just finished a duplex in downtown Vancouver right by waterfront. If you know of the $1 billion waterfront project, it took him 4 months and 9 days, start to finish.
Oh, so we can slash that timeline I put up there? No. I will say this, as we underwrote this project, we were very conservative in all of our estimates. Even the price point that we have, when you look at that end sell value of $9 million, the cost of $6 million, we were very conservative in that to the point where we don't really need to adjust that, based off what the market's done. And the faster we go, obviously, the less interest carry, and so speed is valuable in these.
Yeah, and your market update that you were showing us, it was so crazy because like some of these units we sold for $275, some for $260. I was trying to go as fast as I could, but if I would have, I had offers at $300, which would have, blown up the numbers. But that's okay. We still sold them. We still made good money. But
Yep. And again, if he got stuck with them, he could rent them and he could cash flow positive because we're building the same thing. Talk about this one.
Yeah, and so that one was, the recent one was East Vancouver, way far east, outside of almost the city. This project is located less than a mile from Fessenden, and the average sale on this one was about $380 from what I recall. and there was a second fiveplex right here. So both of them sold fairly quickly. And what's interesting is the average moving was about 360, 370. The current market today, the average is 400, 420. So although we took a big hit in general with the recession, we're seeing these being listed and going pending for more than what it was before.
As long as it's a good area.
Right.
And so talk about Fessenden really quick. Did I have the thing in here? Right here. So this is the actual, no, is this, yeah, that's Fessenden.
This
Yep.
is it.
This is the actual project that we're doing with them. So talk to that really quick, and then we'll wrap it up.
Well, yeah, we have a sixplex, and then we have the second tax parcel.
So 2 different lots that we're able to buy and combine. We're demoing a old structure that's right here. So these 6 will go first, right?
Yep.
And then followed by these. So what is it, the total? 32?
Yeah, so this is 25 units. The
25.
first phase is going to be the 6, just because there's 2 tax parcels. We're pushing the city really fast to where we can break ground, and we typically phase them about 4 weeks apart. And so when the first one starts, we got building 2, 3, and 4. This is what a sixplex would look like, feeding that way. And then we have a different elevation for the other 2 buildings to where it's all front loaded to the street.
So really cool architecture. It's interesting, as I was driving around that mark with them, it was this type of product mixed with older product, and you could see the older product all transitioning to this. So you could see people buying and demoing and then putting up product like this. Literally in these neighborhoods, you'd see $800 million residences, single family homes, and then these townhouses all mixed in. And it's an area where, you know, a lot of people bike, walk, public transportation. You don't need a ton of parking, which is actually awesome because I couldn't have fit this many units in my Arizona projects. I had to allocate way more parking, but we don't need to because the buyers or the tenants don't require it. So we can get more houses, which is just more profit, right, per acreage. And you can get the permits and approvals because the city knows that they don't need it, and so they don't require it.
Yeah, and the great thing about the infill, so we also, on the Vancouver side, like you said, we have to do alleyways, we have to put 2-car garages with parking. Here we don't do that, but it's an infill project, and there's quite a bit of infill where you tear down an old house and you can make it happen versus outside or outskirts of city of Portland. People don't want to live in this. They want to live in a single-family home with a 2-car garage, with a driveway, with a backyard. So this is a completely different buyer that is lacking, and it's a little bit more complex to the infill site, and we've really focused and we've dialed into how to get through that process.
Yep. Awesome. Okay, give it up for Ruben Arthur. Thanks, guys. Thank you. So we're going to look at doing more projects with these guys, and that's kind of when I was talking about development type of opportunities that I really feel like are going to be out there, especially over the next year. So we haven't gone and bought any land for the last 3 or 4 months because we're waiting to see what's going to happen, how good of deals can we get. And, you know, I think that's the next 12 months, there's going to be a lot of them. Okay. The last thing I'm going to go over, and then I'm going to wrap it up. Oh, this is just the agent that helps with all the liquidations. They talked about him. But he's phenomenal. He's been instrumental in helping us kind of create the actual product. What does the market want? What does it need? He's super network connected, and so this is the gentleman that's running the sales team and on the marketing side, and we have very strategic plans as to when we start marketing, promoting, all of that type of stuff. You know, how much we occupy the model home, all that stuff is all worked out in this. Okay. Short-term rentals. So I'm going to be pretty quick in this part. But we went in. Same thing, Q1, Q2 last year, right, to kind of start acquiring these short-term rental properties. A couple things. We purchased 5 houses in California, 3 in Arizona. Most of them are all stabilized at this point. We still have 1 in California that was more of a major renovation. We're adding a pool, square footage, all kinds of stuff. So that one's still not rented out. All the other ones are rented and operating. But what we've realized is results are very, very different. Like, we're seeing bigger swings. Some of them are exceeding expectations. Some of them are hitting it. Some of them had more costs associated with them to get them rent ready. For example, I saw one of the invoices come through, I think it was last month, and they had to buy a bunch of space heaters and stuff. It's like, well, until somebody used it in November and they were cold and somebody complained, we didn't know we had to buy space heaters, right? And so there's just kind of these startup costs that you have initially and then just kind of linger. And then I think it's easier to just get them on cruise control, okay, after that. But the results have really varied. And so what we want to do, I think you heard us, here's some of the houses. So you can see, look great. Pools, the interiors, they're all decorated. They all show good. Pictures are good. We have some houses that we need to get a little bit better, like decor, pictures, or plants, or just things that make it show better. And we kind of only learn what you need as you start to do it. And you start to get the feedback of how it all works, okay? But we're really transitioning from, now we're not in startup phase, now we're in management phase, and how do we optimize it? We have to change the wording in the darn Airbnb listing every single week so that it checks the boxes of the algorithm, so it's always popping up the top, and all these different, okay, how do we optimize the performance here, okay? But what we want to do is, I know some of you are investors in here, I believe, but we really believe the fund model is the best way to go. We've slow in setting up a specific STR fund. We've talked about this before a little bit, because I really feel like that's the best place to do these STRs, rather than just pick them off and have groups of people, because one could knock it out of the park and one could not do as well. Collectively, it can still be very positive. But if they're individually owned, it feels very different. It's a very different experience, and we kind of want to equalize that playing field. So we really feel like the fund model is the best way to do this. So what we want to do, there's 3 STRs that are individually or investor-owned, not inside of one of the funds. We want to transition those over into the funds. So we'll be getting with each of you individually, get details out, but long of the short of it is, we'll make sure that everybody is made 100% whole on all the money they put into it. And the reality is Chris is going to write a check personally in order to make this happen, because you have startup or closing costs, right, when you acquire. You have costs to get it over, and we're gonna move them into the consortium funds, and we have 2 masters. We can't have the consortium fund pay a price that's not a good buy, because then that doesn't make sense. And so Chris is just going to literally write a check. Pretty significant check when you add it all up to cover that, to say, let's make these guys whole, let's get it over here, and then this is going to be a more effective and easier way to manage this, okay? So we're going to get with you guys on that. And now that we're in optimization phase, we're going to bring in an STR specialist that'll just work on managing the STRs. And I think that'll really position us to then say, okay, now how do we take this to the next level and really go to the fund? But this market is interesting too, because it softened, right? When we bought these, most of these we bought in the summer. So looking back, sucky time to buy it, kind of, right? Some of our rates are okay, some of the rates aren't great on them. But as the market slowed a little bit, travel slowed a little bit, right? So again, some of the bookings have exceeded expectations, some of the bookings haven't quite hit expectations. When we look at forecasted bookings, they look very positive. When you look into March, April, well, February, March, April, that's as far as we kind of look at them. But I think there's going to be really good opportunity to acquire STRs over the next 12 months if they start going on sale. And so we want to make sure we're positioned to do that. But we'll get with everybody on that, and make sure that everybody, it makes sense, that you're in agreement with it, and just kind of walk through all of that, okay? That's all I'll spend on that. Let's take just a couple, let's do some Q&A, but I'm going to bring Chris back up to do some Q&A. We'll take 5-10 minutes on that, and then we'll wrap things up. So wherever you are, should I make a tight shirt comment? Or You changing your shoes? What are you doing? Let's start Q&A without him, and then whenever he wants to come, he'll come. How's that?
I'm stuffing my face full of food. That's
Yeah.
what I'm doing.
Yeah. Give it up for Chris. All right. Sorry. I should have gave him the 40 more seconds it tells me to on the clock.
Hey, real quick, just pause. So Tyler, when you're presenting and the clock says 40 more seconds, and my team is force-feeding chicken and rice down my throat to
Take
be
the
on
40
point,
seconds. Sorry.
I'm actually following the plan.
I should get extra credit for being on time. I think
You
I'm the
broke
only
protocol.
one that's been on time.
Listen, don't involve the children. I'm just telling you. Watch, it still says I have 16 seconds. Watch
Okay.
this.
While Chris is taking his drink, let's go first question right here.
Hey, Tyler, I'm here. Hey, how's everyone guys doing up for Tyler Bennett?
All right, we got a question right here, Chris.
So, Tyler, you mentioned that...
Inappropriate. We don't know your name.
Hey, everyone. Ernesto.
Hey, Ernesto.
So, Tyler, you mentioned that these big corporations, that they're now going into single family and they're going in pretty hardcore. So what does that mean then for multifamily, if anything?
I think they're going to keep buying multifamily just like they have been, and they're just allocating additional or doing additional raises and saying, let's go single family. But you saw how much construction is happening in multifamily. And I think a lot of people that are building to sell are going to be forced to hold. But I don't think they're going to have any issues finding tenants. Because if less people are buying houses, they still need a place to live and they need affordable housing. And so that's where multifamily comes in. So I think you'll just see less transactions and more just holds.
Here's what I'd also add. Historically speaking, REITs aren't interested in single family. Yeah. They see single family's time has come. And right now, over the next 10 years, and I'm about to say something kind of scary, dystopian looking. The World Economic Forum envisions a 2030 where you own nothing and life is a service. Someone owns your house, someone owns your car, someone owns everything. And you're literally just in someone's video game playing their rules. And so part of that strategy is they want to commoditize housing, which means people don't own houses. We own the houses. It's a part of a movement that is a reverse side of capitalism that I don't like, that sounds a little bit socialistic, that becomes somewhat communistic. And so I'm just trying to inspire as many people as possible. Yes, ROI in single family, its day has come. People understand you're missing 3.8 million homes. That has to rectify itself over the next decade, and you're either going to play and win, or you're going to give up and forfeit your rights as people are, and they're going to lose. So it's new for them to play this sector. Give it up for Ernesto. Great question.
Any others?
Name.
I'm Russ.
Hey!
Russ.
Wait, real quick. Guys, what row is Russ on?
Yeah, always.
Where in the row is he? Now, the cool thing is we have a lot of people, like, frankly, you're all kind of front rowers, but I think he wins the award for the most interactive, which is pretty awesome, right? I mean, he's definitely taking advantage of his opportunity. Give it up for Russ for that. I love that. Awesome, brother. Awesome.
I appreciate that, brother. Super quick before I ask my question, I want to thank you. We kind of have an idea of all the work to make this available, but we don't have an idea. The legal and the money and everything. So we've been talking about it. Everybody is so thankful for you and your team for letting
Thank
us
you
have
very
this
much,
opportunity.
team. Thank you. Thank you. Yeah. And I just got to say, it's a pleasure. And it's exciting for us to do it. And we've got it organized at this point, and we're glad that you're in a position to take advantage of it. So let's hear it.
Don't stop it.
You won't. Okay. I hear you.
So my question for both you guys, the couple you mentioned the other day that's looking to sell their house and take the equity, we're looking to do the same thing, and we should be able to get about $500,000 in equity. In the meantime, I've got a $375,000 line of credit, so which I can borrow probably at 8%. Would you recommend, in the meantime, or if the selling does not work, borrowing against that to invest in, either the consortium or the Audacity Fund?
Great question. So someone that was going to join the club had asked, can I join the club if I'm just going to come in with home equity? And I said, it's really not my preference. And if you are planning on selling the house, and this is still a good market to sell real estate in, there's obviously, a larger home. And so you'd want to ask, what does realistic days on market maybe look like for that strategically? When in the next 24 months does that make sense? And if I knew that I had a shorter leash on that, then I feel great about deploying that money. Based also on what I know about your financial situation, you're not tight for cash, which means you have some license in that game. And I would absolutely be deploying that if you're following through on the other end, on the other intention.
Awesome. Thank you.
Yeah, 100%. Give it up for us. If you only had 2 more questions with the one and only Tyler Bennett, let's hear some. Let's hear them. We're going to come all the way over here.
My name is Scott,
Hey, Scott.
and I want to pick your brains real quick because I don't really do single family, but I develop and deal in multifamily down in the southeastern market in Georgia, Sunbelt area. So we've got a deal. It's roughly 350 apartments and 40 towns, and we've got 40% of the equity into it already. But now the banks, we wanted to break ground end of March. Now the banks have tightened down on the construction loan. So originally, before we could get like a 65-35 split from the bank, but now they want 50-50, 50% in. Any thoughts on securing construction money?
Switch banks.
We tried.
Yeah, they want 50.
Yeah, they're asking for 50%.
What's the price tag on the project?
It's about 172 million.
Yeah. So your options are raise more equity to get to the 50,
Right.
or pause, which
Yeah, pause is
isn't
probably
an
not a
option.
good thing.
Yeah, you've
Do
already
the,
raised
do
the
the
equity.
numbers pencil out at 50%?
They'll pencil out. I mean, we've adjusted the cap rate, and they will. But I mean, obviously, it's not as good for the investors. But
Yeah.
Less
we can-
leverage.
we can make it work. But
Can you phase it?
we could. I mean,
Could you get less? Could you get the 65 terms if you didn't ask for as much and
don't know.
phased it?
it's a possibility.
Because I've done a project, not that big, but kind of similar to it, where we phased it, and then we set up the lending so it was almost like a line of credit.
Right.
So as we sold, it went back to it, and then that opened up so we could keep going, and then we got more aggressive terms. I don't know. That's just a big project. The
Right.
appetite for that type of lending is
Well, we have 2 more backed up behind that one too. So
Does everyone understand the dilemma? He's probably 12 to 18 months into the project.
yeah. Oh yeah.
So a lot of time and effort has been put into it, has raised probably somewhere around 40, 50,
A little more.
$60 million dollars.
Yeah.
And so he has investors, he has commitments, and if the bank comes back and alters the terms and says, wait a second, we want you to put up 50%, not 35%. On the one hand, it's like, well, that's just 15% more. Obviously, on 172 million, then 15% is another 25, 30 million. So it's the question of, well, we got 60, but now we need to go find another 25 million. But what it also means, when he's talking about the cap rate, is that the less you leverage, the lower your cap rate goes. So now you have investors that are saying, hey, I was participating in the deal with a certain level of performance, and without leverage from the bank, that's going to start hurting that cap rate. So now it becomes a really funky dance of,
Right.
I'm a couple years in, I've raised 60 million, now I need another 25 million, and I'm selling that on slightly lower cap rates. What can I do? And I just wanted to articulate that. Does that make sense? It's the same thing I face in Crone Consortium when we raise money in the real estate fund for doing all cash deals. That only works if I put my name on the line, I do a personal guarantee, the bank lends us up to 70%, and then I have to create a greater equity split outside of the 50-50 and go 70-30 so that I can catch up in my ROI because we're not using it. It's a safer position and it's not as much debt. And that's kind of that's the game that you've got to play with the levels of, do I Do I phase it? Can I work with the bank and take it out in chunks? Will they give me more aggressive terms?
We're actually looking at a bank in. So one of the investors, there's a fund called the Thunderbolt Fund, and one of the primaries in that fund has a banking relationship with a bank. I think it's called Sava Bank in Madrid, Spain. So we're even going overseas to look for money.
Are you personally guaranteeing? Like the signers, are they personally guaranteeing?
Oh yeah.
So you couldn't throw that in that you'd be willing to try to improve that. That's already on the table. I don't know. That's a tough dilemma.
That's a rock and a hard place.
It is.
Yeah.
It's fun.
Yeah.
The reality is if you can make investors happy by lowering cap rates a little bit,
Yeah.
then it's just a matter of getting another 20, 25 million. It's a very small amount of money.
Good news is lumber's cheaper.
It is. You're right. It is. I know. I was talking to Dan and to see if he could start working. What's his Thatch? I'm sorry. Yeah, Thatch, in the construction side soon.
Yeah.
I like it.
There you go.
All right, guys. Scott, I wish we had something better for you on that,
Yeah.
on spitballing. But guys, give it up for Scott for taking down a mammoth.
Yeah.
It's good, brother.
It's a big project.
Okay, we're gonna do one more question. We're gonna come right here. Give us your name.
Check. My name's Billy.
Hey, Billy.
Hey, Scott, what would happen if you increase the amenities such that you could, project having higher rates on the leases? That would improve the cash flow? Is that a possibility? Like maybe you weren't putting a pool, now you do?
He's saying it's a high-end project and they're very amenity heavy, so there's not a lot of
Already.
value add they can do on a new
Okay,
build.
gotcha.
Even with more cash flow projected, that probably wouldn't change the construction lending terms.
It was a
Because
thought.
those guys
Okay.
are taken out at that point anyways. Yeah. Good thought.
It is brainstorming, yeah.
That-
So
I'd like to meet you afterwards, though, Scott. So that was my feedback was, trying to tag into that, and I want to learn more about multifamily.
Cool.
here's the really cool thing. Raise your hand if you actually have a problem that you yourself are currently trying to solve. And I should see every hand up because I promise you, like, this is not a trick question. If you have a problem you're trying to solve financially, raise your hand. Every one of us here, by the way, entrepreneurs just might make money by solving problems, right? And so problems aren't a bad word. Problems are a good word because we always know that they're really opportunities. So I love that. And we always want to keep that going because that's really the value here. I want to summarize, I think, what I've heard Tyler say, and you guys tell me if I'm spot on or maybe a little bit off. Tyler, what I'm hearing you saying is that with the projects we're doing in the Equity Bridge Fund and especially the Portland deal over the next year, as that amortizes, we are targeting to hit our 15%. We want to be in that 15 to 20% range. We're not deploying enough capital to hit closer to 20, but we're going to be over that 15% mark. True or false?
True.
Awesome. So guys, Equity Bridge Fund, it's doing its thing and it's working. And Tyler Bennett has been instrumental in making that happen. So let's give it up for Tyler.
Thank you. Thank you.
Yeah. In the short-term rental game, we've done a series of them. Biggest takeaway lesson is that if you bet on a high-end but single project and you have a variety of ROIs that range from a 40% cash on cash down to a 15% cash on cash, if you pull them together and blend them together, then all the investors get to sharely lower the risk and win together. True or false?
True.
By the way, that's why we are going to be working towards our STR fund, and Tyler's given a really good update on what that looks like for those that have been participating in that, and I think it's going to be really hot when it comes. We started with individual syndication, as we've mentioned, but honestly, working together as a team and a group is what's really going to make that game long-term sustainable. And Tyler's team has been very instrumental on the STR front as well, so I'd honestly give it up to him and his team. They've been crushing that on our STRs. Thank you. Last one. I think I'm hearing that, and it's really important that we don't overlook building a portfolio in single-family homes. It is the one asset class that is different than everything that we have talked about. And I assume because we're real estate partners that we don't need to spend a ton of time on it, but that doesn't mean it's not important. Many of you in this room can buy a handful of homes and 20 years from now wake up with 100. And I promise you that there's so much value in playing a long game versus a short game. I think one of the reasons why Tyler and I get along so well is we both play the long game. We like short games too, but we're always prioritizing, I want to wake up in 20 years and I want everything to look 1,000 times better. And that's what single family is. So make sure as a member of this organization, because we're partners for life, ignite that when you're given the opportunity of what choices do I want to make in my personal game plan? Because Tyler, right now, from what we've been doing the last 10 years, I mean, when I look at 2008, 9, 10, 11, I wish we could go back in time and do 10x on that.
Yeah.
But then as we saw 12, 13, 14, 15, everything for the last decade emerge, it has been us working crazy hard to compete in the market. And we have done it year after year, and our ROIs have been awesome. But we have just been handed a gift. And that gift is easy grabs, much higher ROI. And if there was a time to go heavy into single family, this is going to be the year. Did I get that right?
100%.
Guys, give it up for Tyler. He's the one that also makes that happen.
Thank you.
Everything on the real estate side, I just want to express appreciation, Tyler, to you. You know, it's been a really, we've been working in this together for a long time. And last night we were at Top Golf, and I was reminiscing, and I thought, have I ever had a kerfuffle with Tyler? I was honestly reflecting. Was there ever a personality difference? A character difference? Was there ever a transaction that irked or peeved or upset? And I reflected on the last 15 plus years and I realized I don't think I've had one negative interaction personally with Tyler. And that's through solving a lot of problems and helping create wealth for a lot of people and doing high volume in the billions of transactions. I just feel honored today to share a stage with a man of that level of integrity and character because really you are only as good as the people that you hang out with. It's my privilege to have him as a partner in what we do together. And brother, thank you so much for being you. Guys, give it up for Tyler Bennett.
Thank you, Chris.
Thank you, brother. Appreciate you.
Thank you.
Thank you.